Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I give you the insider's guide to property investing. Good morning, Ben.
G'day, mate. How are you?
Good. I think I say, how you go, mate, every single week, so I thought I'd mix it up.
Oh, do you listen to it?
Don't want to be predictable.
Hey, I want to talk footy because we haven't talked footy for a couple of weeks. And we've been on the winner's circle. So can we talk footy?
How was AREC, by the way, on the weekend? Because isn't this where I get lined up again? I think a lot of our listeners are probably, this is a dream for them because Fremantle 0-9, I can't be bothered talking about them. And you're not doing that much better.
You haven't got the sympathy vote? You're not getting any people reaching out to you saying, I'm really sorry about Freo and how poor they're performing?
No. Constant heckling.
Yet we can lose a few games and, Buckley's going to get sacked.
Yeah, but...
so I don't know how that works in terms of, Ross Lyon can turn a team that finishes on the top of the ladder and still be safe as houses in his job. Not quite sure how that works.
Funny you say safe as houses because remember he's rewiring, re-stumping and re-plumbing. Hey, we went to AREC on the weekend, Australian Real Estate Conference. We were a bit of fish out of water there because we don't list property for a living. But having said that, there was a few things that were common ground for us. One, there were some really elite performers in terms of understanding what they do to be elite, and we're very interested in those things that they do.
High-performing people. We're very interested in learning about how they work.
And the other thing, obviously, is real estate. Residential real estate is the common language. So it was a good couple of days. We got some good things to share. But Frederick Eklund, for all those $1 million listing folk out there, because you know that, don't you?
I have not seen 1 second of that show. So I have no idea who he was until he turned up. And I'm like, rightio, I've seen that face around. But yeah, had no idea.
He did 4,000 people in the room, and he wanted everyone to do his trademark whee and the high kick.
Right.
And I think he was going for a Guinness Book
World record.
So I think he achieved that. He is the number one in his mind. He's the number one broker in the world, and he moves over $1 billion worth of real estate every year. So it was good to get some insights. But apart from him, there was a whole heap of speakers. Any in particular takeaways that stood out for you for the benefit of the listeners?
Yeah, look, I'm always interested in what's happening in the future. So I like the conversation from is it Daniel Petrie? He was excellent. He's a tech investor now, but his background was he worked heavily in Microsoft and was very high up in the Microsoft organisation. Had over 500 programmers. So some of the takeaways from him were quite interesting around, disturbance in terms of technology disturbance. And he was talking about the real estate agent industry in terms of that it's the only industry in the world where there's been an income spike because the valuations of properties have grown, as opposed to most other industries are suffering margin squeeze because of technology disruption. So that the artificial intelligence, the machine learning stuff that he was talking about is incredibly mind-boggling. I'll give you here's an example, listeners. He talked about the Google cars, so the self-driving cars, and they Google and Uber put their data together for New York City, okay? And they basically tried to work out with these cars how efficient they would be in moving people around New York, which is obviously one of the heavily congested cities in the world in terms of car movements. And they worked out that any person who is waiting for a car would wait something like 17 to 19 seconds before they would have a car there to take them to their destination. Now, if you think about that, you can get in the car, the machine drives you, takes you to your destination, and that's efficiency. And that sort of stuff just blows my mind because, he was talking about that our children's children will never learn how to drive.
Isn't that amazing?
Yeah, and that's, he talked about how they've done 2 million hours of driving these Google cars around LA, and I think they've had a total of 14 crashes, of which 13 crashes have been caused by other drivers, and there's one debatable crash recently where the Google car had its nose out from a corner and the bus clipped it as it went through. Now, he was arguing that one could argue that the bus driver wasn't quite in his lane.
Yeah.
But so it's just fascinating to sort of see what technology can do. And in our business, we're spending a lot of money in terms of trying to get better at our research and trying to get predictive modelling software up and running to, try and help our clients get the best returns they can.
Can you imagine the conversations you have with your grandparents right now is, well, when I was a kid, we used to have to wind the window up ourselves. Now the grandkids of the future, they'll be having a conversation. We used to actually have to drive ourselves, whereas now we don't have to press a button that gets a car to arrive in 17 seconds, and then I don't even have to worry about if I'm going to have a car park.
So you think about that from a property perspective, and this is, I want to unpack this a little bit because you've got me thinking. So I've obviously have been anti-apartment living, in terms of medium and high density apartment from an investment return. And the reason I have been that is primarily around the conveniences of moving a family around. So, if the developers only build 1 and 2 bedroom apartments, it's very unlikely you'll move a family in there. But families will have an interest in it. But then they sort of sit back and they go, well, I've got 2 cars because, little Johnny needs to go to his guitar lesson and little Sarah needs to go to her netball lesson. And so to just sort of think, well, I'll just get public transport to take me there is like sort of saying, well, that's going to take an hour and a half for the bus to connect to the train and so people just go, no, and they need that second car to be able to get around. Well, could you imagine if you're living in a city where you just basically can get your smartphone and basically hit a button and the car turns up, doesn't matter which car it is, and you get in it and it takes you to where you need to go. All of a sudden, that type of living may be appealing because what you do get in these sort of higher density areas is a lot of convenience. You get everything, within walking distance of what you're looking for. So I think, if we took a 20-year view, there is no doubt that there's going to be a shift towards more density living and people potentially wanting nice views and all those types of things. So there's still going to be some challenges. I mean, from an investment point of view, they're very expensive in terms of how they operate in regards to the cost of maintaining them, the lifts, and like if you've got to repaint the building, it's hundreds of thousands of dollars, and it takes over a year to do. So there's all those little things from an investment return point of view. But if society and if owner-occupiers start to think that that's an acceptable form of living, well, then you're going to see price growth over time.
Yeah, some people already do that now where they don't have a car during the week and they do that share car arrangement on the weekend so they can bust out and go for a drive and catch up with their friends. So there's a hybrid version.
There's early adopters, but you want it mainstream for it to impact on valuations of property.
Yeah. And we've always said that we want to adopt what contemporary trends are coming because we acknowledge that even here in Australia, a period home is highly valued. But as we become more Asian in our multicultural communities, they don't value that. So over time, that will change. So you've always got to be reflecting on the trend at the time. But right now,
look, and our investor clients they're playing the long game, and for the listeners, that's what you should be doing too. You shouldn't be speculating in property. It's going to be a horror story around valuations in some of these marketplaces in the course of the next 18 months.
Mate, I agree that the speaker that you just spoke of probably has the best takeaways for the benefit of our listeners because there's some awesome takeaways if you're want to be an elite real estate agent. But he talked about self-develop, not shelf-develop. So it's no good just having a bookshelf full of books that you've read and you've never implemented, and that's an extension of knowledge is what's yours? Knowledge is
empowering,
power.
But only if you act on it. So he's right.
So self-develop, don't shelf-develop. So that's a good one for anyone of our listeners who's got 100 books on property but they've never actually invested in a property. Yeah. You've got to get off your chair and do it.
Love it.
Success has always been the product of a team effort. And he goes, I've seen so many high-performing individuals, but the ones that I'm really interested are the team. So that applies to property investors because people in silos and in isolation generally don't do as well as the people that take on a team environment.
Yeah, and because more heads are better than one. Pretty simple, isn't it, really? Yeah. As long as the people who are in the group have some talent.
Blind spots.
Understanding what you're doing. If you build a team of people who are passionate about football and they want to invest in property, well, that's no good. But if you're going to build a property investment plan and passive income for life, you want to be surrounded by people who know what they're talking about.
Correct.
And leverage from their knowledge. Yeah.
Do you remember how we were talking on the drive back from the Gold Coast to Brisbane the other day, and I said there's that little light that's on the rear vision mirror that tells you when the car's in your blind spot? Yeah. That's what the team does. It gives you that little light.
Love it.
To know what's in your blind spot. The magic happens outside of your comfort zone. That came up with a few speakers. So if anyone actually has been thinking about investing in property for some time, they've been listening to our podcast, they feel like they've got the frameworks and the reference points now, and they just can't, the magic does actually happen when they do step out of their comfort zone.
That's the growth story, isn't it? That's the human growth story, and it's everything. Like, investing in property still carries risks. So if you think about it like that as well, you are getting out of comfort. I mean, every property that I've ever bought, I still have that moment of weakness where I have that buyer's remorse.
Gulp.
Is this the right one?
Yeah.
And we do that for every time we buy it for clients.
On every purchase.
Every
I've got to tell you,
purchase.
I've been doing it for
and that's that
personally,
nervous energy.
professionally for 16 years, and I have that gulp every single time.
Yeah, it's the nervous energy that you want to have, but then you go back to the fundamentals, and if they stack up, it's a good execution.
Agreed. Last one that I want to mention is business is constant whitewater, and I'm thinking that was good. You always look for clear water in us running a business.
Yeah.
But I thought, how does that relate to property investors? Property investing can be seen as constant whitewater. If you will have a tenant that has an issue, or you might get a crack in a tile in the bathroom and the water might leak through and there's a bit of those things. If you just see that in property investing isn't going to be always clear water, there's going to be a state of white water. You can actually almost enjoy it when a challenge comes your way, because you've anticipated it. You're not looking for the nirvana of clear water all the time.
Yep.
So all that was something you could relay into property investing as well.
Yeah, look, I love that statement from a business owner point of view, and just in general business that I've been in all my life, is that if you're not pushing yourself hard enough, in other words, if you're not challenging yourself, then it might be clear water, but it would be a pretty ordinary business that you're more likely to be in, which will create that white water. The white water you want to create is in advancement, and if we're talking about wealth creation, that's exactly right. So you get, what we try and do is clear that white water by sort of giving them advice and guidance, cash flow management, all those types of things. So we still think that once you've finished the purchase, it should be relatively safe, but you can create a lot of white water and backwash if you don't have your property manager doing 6-month inspections, if you're not making sure that your cash flows in order. Those types of things are really important.
Money smarts is not in order.
Exactly.
But the white water doesn't have to be sort of, monumental things. It can just be slight white water, but it's just not expecting it to be perfect.
Correct.
And I must admit, anecdotally, I don't have any study around this, but over a period of time, I've always found, and I've got to be careful with words here because it could be, I don't mean to be judgmental, but I've always found blue collar workers don't look for it to be perfect, and white collar workers look for it to be perfect. I know it's a gross generalisation, but generally, the blue collar worker just goes, I've got to get it done. It's not going to be perfect, and they
more easygoing, you think?
Well, they just have less anxiety around it. Whereas the white collar workers who are used to, models, particularly if you're in a space where there is a black and white answer, whereas there's a bit of grey in property investing. I've just found it, and I've got no study or science around it.
Naive bliss? I mean, some people go through life really happy, and they have a certain level of awareness about the world.
I just think paralysis analysis. It's almost the blue collar worker, again generalised, and I don't want to offend anyone, but they're comfortable with the white water.
Yeah,
and
it's a good point.
The white collar workers probably get a little more anxious around the white water.
Well, they're more investigative. I think and when you get that investigation, you get contradictions, don't you? So, I was having a chat with someone last night who's completely overwhelmed. She's so overwhelmed with the whole story that she's paralysing herself, and she's getting mixed messages from the people that she's talking to. So it's, at that stage, you literally have to rewire, you have to reboot, or ultimately you've got yourself into such a position that it really isn't sensible for you to do anything, and that comes back to that risk profile. Her risk profile is, I am so risk adverse, so conservative that, and I want the best outcome, and I see all these valuations moving forward, and I haven't done anything yet. So from that point of view, that's a really interesting conversation to have with someone, because if we have a conversation with those people, it's like we want to hold their hands and go as slow as possible, and to build up their confidence. But if that is also, but the market's moving, but the market's, it's just a really, really difficult situation for them to be in. And I sympathise with her, because it was like it was really affecting her physical state, and so we've got to step back and reassess everything and really work through that situation to see whether it's right for her or not.
I know what you're thinking. If she needs to rewire and reboot, she needs to talk to Ross Lyon. He's all about that. Hey, before we go on to a few questions that we've got today around asset selection, you haven't seen them. I've had a quick look, but there's nothing too curly here that you wouldn't eat up for breakfast. But Tom, last week, reached out to you via LinkedIn.
He did. So
update for the listeners.
Look, the update for the listeners at this stage is just simply that we've got him completing the fact find. And so I'll be talking to him hopefully in the next couple of weeks, and we'll see what we can find out about his situation.
Remember how we always talk about, isn't it interesting to try and think about where someone is actually listening to our podcast? Are they at the gym? Are they commuting to work? He was late on a Thursday night, feeding his young child, had the headphones on, and he reckons he almost threw the baby out the window. When we mentioned
They're talking about me. They're talking about me.
Talking about real people on this podcast.
Yeah, we do.
Okay, so there's a few questions that I wanted to run through here, Ben, with sort of asset selection in mind. This one's from James. Love the podcast. Just have a question that you can hopefully answer on the next question show. Just wondering if there's a big difference between investing in a 2-bedroom house or a 3-bedroom house. Everyone is telling me the more bedrooms, the better. However, others have told me that in investment, it doesn't matter. Thanks. So for me, I always think it's context. It's all about context. So I've bought 2-bedroom houses and I've bought 4-bedroom houses. I've never actually bought a 1-bedroom house, but it's all about context. So the closer I am into the main heart of the employment centre, the more comfortable I am with a 2-bedroom house. The further I move out, there's a 3. So there's no blanket on whether you should or shouldn't buy for a 2-bedroom. But if I'm walking into a suburb and the context is that everyone normally is buying a 3-bedroom house, and I put myself out there and buy a 2-bedroom house, I reckon I'm asking for trouble. Because the norm would suggest, the context of that particular suburb would suggest that I'm moving outside of the bell curve. Whereas if I'm buying in Yarraville, or I'm buying in Sydney, Marrickville, or Newtown, or New Farm up in Brizzy, if I'm buying in, let me think of Perth, if I'm buying in South Perth, in Adelaide, if I'm buying in Unley, no brainer to buy a 2-bedroom house. But if I'm buying further out, if Sunshine, for example, in Western Melbourne, I'd probably want to buy a 3-bedroom house. Thoughts?
Yeah, no, that's exactly right. I mean, you're talking about the demographic of the audience who will accept that 2-bedroom accommodation. So it could be a young couple that are just starting out and, want to get on the property ladder. Because you've got to remember, let's bring this all back to owner-occupier appeal. Because, owner-occupiers set the price, investors take the price. So when that's occurring and you know that there's pent-up demand for that type of accommodation in that area, so you sort of understand what it is that it's offering them. So usually in a city close to town, it's convenience, it's lifestyle, it's all those things. And the further you go out, the less of that's on offer in terms of, being able to wander down to the local shops or whatever it may be. So that's what we look at. We look at the context of the underlying demand for the interest in that. So you might have a gay couple, you might have a young couple who simply don't want to have kids, and you have them in good numbers. They're very comfortable in taking on that two-bedroom house accommodation. Those, as I said, those entry people into that type of accommodation as well. Because when you think about it, if the median house price is 1.5 for a 4-bedroom and 1.3 for a 3-bedroom, and then you're coming down into 900s, people still see that as affordable, and that's where that conversation is going to lead. And as we get more and more density and greater populations, that's why we think that villas and townhouses will also take on the same appeal as what 2-bedroom houses are doing.
So if we go back to earlier podcasts, location will do 80% of the heavy lifting. Think of Richmond here in Melbourne. Yeah. Everyone wants to live in Richmond. It's one suburb from the city. You can walk to the MCG. It's got pub central. It's got a train that runs through it. There's cafes and restaurants galore. So if I want to live in Richmond and I can't afford a house, I'm going to buy a 3-bedroom townhouse. I can't afford a 3-bedroom townhouse, I'm going to buy a 2-bedroom townhouse. I'm going to stay in Richmond and just do what my money can afford.
Yeah.
So it sort of still gets anchored back to the location.
And we're going to do something on that in the coming weeks around basically looking at the audiences and then having a look at the accommodation stock and sort of showing the viewers and listeners. And when I say viewers, because we're going to do that in a video sense. We're actually going to shoot a video, which we'll talk more about later. But that's ultimately going to be our first episode, I believe, where we're going to sort of play around with that concept, and that'll start to give people context in terms of the interest and the desire for the types of accommodation, and that's what drives value.
Very good point, Ben.
Had a lot of fun. That's a good one, mate. That was a good one.
So thank you to James for that one. Matt sent one in. Hi, my wife and I are on the move from Newcastle to Coffs Harbour on the New South Wales mid-north coast. Our house is in Whitebridge. It is our first home, which we purchased in 2011 for $365,000 and is currently valued at $490,000, so got some growth. Ideally, we'd like to keep our house in Whitebridge as an investment property and look to buy in Coffs Harbour. The rental return will be $420, which comfortably covers the mortgage at interest only. I see the house as being a good investment grade property and ticks the boxes that you both talk about in the podcast, just after your initial thoughts on the situation. The first thing that comes to mind for me, Ben, on that one is one of the things that in that situation, it's only in hindsight that you realise that finance structure was really critical, because we often say to our clients, and this is not advice, we say to our clients, on your principal place of residence, instead of paying principal and interest, pay interest only. And once we cue the crickets and they give us that double blink look and go, are you mad? Because my parents told us we should pay off everything.
Yes.
We go, but we think that you should add an offset account to that so that you can do exactly the same as you would with a principal and interest payment, but you can control your cash. If we flow that on, if this person had, when they bought it, done that and built up some money in their
and they may have
offset account, they could actually transfer that money to their new principal place of residence, and the old house has had the debt untouched, and now it's a tax deductible debt, and they can get better tax advantages.
Correct,
for it.
at a higher valuation. So that's good advice. In terms of the other broader piece, in theory, yes, we love accumulating properties. So if this property is going to look after itself, and the fact that I like that it's a house, so it's got a bit of land, so that sort of underpins it, even if it's in a large regional town. We like that. So I think it's a sensible move, so long as your cash flows allow you to buy the property that you want to buy to enjoy your time in Coffs Harbour. But yeah, I think it's a bit of a no-brainer on paper. The devil's in the detail. But yeah, I love the idea.
Very good. There you go, Matt. Hopefully that's helped you. Let us know. And there's one about strata, Ben. Hi, gents. I've been binge listening to all the episodes last week. I liked the bit about this. And I even ran out of downloaded episodes and pulled into McDonald's to steal their Wi-Fi for a couple of extra episodes to get me home. So apologies to McDonald's. We're not suggesting that's.
Thank you, McDonald's, for creating someone to build knowledge.
Exactly. And as long as they got the 30-cent cone, mate, they're contributing to.
Well, they just stay in the car park. I just love the fact that McDonald's are educating people. There's
actually a very good point there. I've got a couple of questions about strata properties. We have 2 townhouses. One is in a smaller complex with 8 townhouses, and the levies are reasonable. There is rarely any issues with maintenance. The other one, in brackets, our first purchase with 2 exclamation marks, not one, is in a complex with 30 townhouses units. The units have lift access, underground parking, and we're paying about $985 a quarter in levy, so almost $4,000 a year. We're constantly getting correspondence from the strata company with owners having maintenance issues, leaking toilets, graffiti removal, underground car park issues. We've committed to the property. It will give good growth and should be neutrally geared in the years to come. Held for 2 years to date, so selling is out of the equation. So here's the questions. Would love to hear your thoughts on strata. When is it a good idea and when is it a bad idea? And there's a couple more. We'll start on that.
She's answered her own question there, but she's just probably in a little bit of denial.
Yes.
In terms of Sarah, yeah. So, you've just described medium density accommodation.
Correct.
And all of the bad bits of it, lifts and underground car parks and poorly built and so forth.
Look, 8 townhouses, there is rarely any issues. 30 townhouses, how long have you got? Yeah.
So there is opportunity cost here, Sarah. So you've got to say, you might be committed to it. I don't know where it is, so that's probably one thing that would play into our decision. So, because remember, location's still going to be important, even in that sort of medium and high density stuff. But the reality for me is there might be opportunity cost loss here. So that means that, put it down as a learning experience and look at alternative options. Because if this thing's only going to give you inflationary growth, but then it's going to soak up all the income in terms of looking after and running the the rent's basically being absorbed by all these costs, and then you got a sinking fund, and don't forget this baby's going to need to be painted probably in the next 10 years, so there's probably another $80,000 in costs. And
that's just to get rid of the graffiti.
Yeah. So it's not a good one, Sarah, and thank you for sharing that, because you've just helped a lot of listeners validate what we talk about.
Yeah. I think the point here, Sarah, is there needs to be context in how it affects your overall situation, because despite some of these challenges, depending on the growth, depending on the yield, depending on what your other circumstances are, there may be a case that, okay, this one is just what we do for income, and we'll make some better decisions later so that you don't have capital gains tax and all that sort of stuff. The second part is, should I be religiously sending back votes for meetings, etc.? And then she goes on and says, when I read the strata documents that require owner response, it's all Dutch to me. Can you explain how to respond to things I can vote on and making sense of the minutes, etc.? Can I just say that I often get a client come in here and say, I refuse to buy anything that's got a strata. And I go, okay, no problem. If location does 80% of the heavy lifting and we decide that the suburb should not be compromised on, that's a limiting statement that you've just made. Because if all you can afford is a strata property in that suburb that's going to do most of the performance for you, you've just ruled it out. So I always say that stratas are more, if you buy a house, you've got effectively the same as a strata levy, because you've got to pay insurance, you've got to maintain it, and you've got to put some money aside to fix it, right? But it's not packaged up nicely on a quarterly basis, and you've got to organise it all yourself. So that's one extreme. The other extreme is you're one of 355,000 people, you're just a number, and it's just a gargantuan. But if you find the right ground, like this first one that's only got 8 townhouses, to me that still has an element of scarcity, as long as it's got context within the suburb.
Yep.
And it's still potentially got elements of owner-occupier appeal. And there's no lift and there's no underground parking, and they've got some reasonable costs. That's something that you'd unbelievably consider if it meant that you could get in the right suburb.
Just count your lucky stars, you didn't have a pool in there as well.
Yeah, that's right.
That would have been the Cornell in terms of pool, tennis court, lifts, gym. Oh, yeah. They're the best ones.
Well, to make Sarah feel better, my first investment property had a pool, it had concierge, it had a lift that my tenants never got the benefit of, had underground parking, it was constantly being broken into for all the cars underneath. So I'm in good company with you, Sarah.
So Sarah, you share, so I'll share. So I bought a property 2 years ago in our complex, 16 in the complex. I bought basically a townhouse in the complex, 3-bedroom, 2-bathroom, and it's got reasonably high, for the location it's in, it's got reasonably high outgoings, but doesn't have lifts, doesn't have any of that type of stuff. Does have a pool because it's in Queensland, and pretty much every complex of accommodation up there has a pool.
Context.
Yeah.
It would be out of context without it.
Correct. So
it's far north Queensland.
In terms of how that looks, so I think I got a good price on it, and there was a resale in the property complex for exactly the same, very comparable to my property. Both of our properties had been renovated by the owners who were trying to sell them, and I've had a 20% gain in the capital growth in 18 months. So that's based on the new resale of the other property recently compared to what I paid for mine. So, and the other thing for me is I have a very high cost because the insurances up there are quite high. So, but it's grossing me 10.8% yield. Now, with my high costs, I'm still getting a net yield of around 5%. So it's still great. It's in my super fund, so it's just going to sit there and set and forget. But we are fastidious. And coming back to your questions about body corporate, I sit on the body corporate. I take an active interest in that body corporate because in reality, I do want this property to be well maintained, well presented. And so I do vote on everything that's coming my way, but I take an active interest in the sinking fund, and I just make sure that this is going to be, now that's the decision that we made. You know, if it's a single home, I've got a property manager who's looking after it. We still have property managers looking after this, but I make sure that I have I play an active role. And obviously I've got a property background, so hopefully I add benefits to all of the other people who are also on the committee. In fact, we're actually going to segregate the backyards on each of these townhouses, and we're going to have individual lots. So that's going to again increase the value by probably another 10% overnight with a small, with basically $3,000 per fence line, and all of a sudden we've got these private courtyards. So that's the type of thing that as soon as I saw it, I thought, this is ridiculous. This is, I'll grab this. And it's worked well for me, but the real cost for me is in the insurance. It's not really in terms of the other costs. I don't have those extra costs.
So for the benefit of everyone, a body corporate is a not-for-profit administration component. So they don't control all the owners. They are there facilitating on behalf of the committee that's been elected by the owners. So if you're one of 8, you have a say. If you're one of 800, you probably don't have much of a say.
No.
So the point is that you determine the budget, At the end of the month, the body corporate goes, this is what I think the body corporate costs are going to be for the next 12 months. Do you agree or disagree? And you get the right to vote. And if you agree, who do you vote in? The chairman and the secretary and the committee members. And they've got the authority to make decisions up to a certain price point, and anything over and above that price point's got to go to a vote from everyone. So we would certainly encourage you to take an active role. It's probably, I don't know, I'm on one of my body corporates, and I'm probably putting in 2 or 3 requests every 2 months where I've got an answer a question that comes through from email.
Yeah, I'm about the same. And then there's the body corporate managers. So just so you understand, you can outsource that management of the minutes and the coordination of anything and making sure all the votes are correctly done. They can be good and bad as well, can't they, Bryce? They can be, I think we've got a really good one where we are. They're very proactive. They're not cheap, but again, I don't want cheap. I want everything to be in order. But you can get some shockers who are hard to get in contact with, poor in response. They're organising sort of everything on behalf of us. So it's not, you don't have to do that. You can self-manage, but you then got all of the compliance and the insurance work and all that. We just like outsource it, I just like to outsource that. But I'm active on the actual body corporate.
That's right. So, I mean, if the costs are going to cost $8,000 for the year, and there's 8 townhouses, there's $1,000 each. And if they want to put $500 a townhouse for the sinking fund, there's, and then they divide it by 8 or they divide it by 300, depending on how many you've got. So to answer that question, it all seems like Dutch to you, but all it is saying this is what's going on in your building, and so that you're fully informed, because a third party is managing it on your behalf and packaging it up nicely. But it's not just some beast with a big stick telling you what to do. The smaller the complex, the more active participation you have, the more control you can have on the outcomes.
Yeah, and now if it is Dutch, i.e. there's engineering and structural problems with the property, well, isn't that another trigger? I mean, that type of stuff is in the tens of thousands. So that could be your exit in terms of, wait a minute, if this is Dutch, I need to talk to someone who understands what this engineering stuff is saying. In other words, has this development been built properly? And if it hasn't, can you go back and try and sue the builder, do whatever it is possible? Because the reality is you could be in a lemon property right there.
That's why I love buying properties that are established and have been around for a while, because they've stood the test of time. We buy routinely 70 style properties. I bought one this week. It was a 70 style property, 1 of 8 in a small body corporate where the fees were $190 a quarter. It's ridiculous.
That's great.
And so there's not much. It's just general insurance and upkeep.
Just a bit of common land.
So there you go, Sarah. I think for the benefit of the listeners, it's just reinforced from your scenario that the smaller, the better within the context of what's normal. And these things don't need to be double Dutch to you. Effectively, it's a third party looking after the body corporate on your behalf and packaging it up as nicely as we can.
Thanks for the question, Sarah.
We're running out of time, Ben. I think we can squeeze one more short one in.
Oh, okay. Geez, that is cool. That time went quick.
From Leighton. Thank you, Leighton. Finding an investment. I'd love to hear Bryce and Ben's thoughts on the property cycle and the part that it plays in the investment decision, and how cycle ties in with timing the market. It seems that different parts of the country operate in different phases of the cycle. Great question.
So true. Markets within markets.
Yeah.
There's no doubt that economic performance has an overlying macro effect. So the CBA release, or ComSec, I think it is, releases a quarterly report called The State of the States. So it's free to download, get on the ComSec website, and it gives them scores in, I think it's 7 or 8 disciplines in terms of how they're operating: employment, economic activity, and then their trend that's been occurring over the last decade. So you can start to see how those state economies are performing, and potentially the city's economy is performing, because that's the truth. And this is why when we think a property market gets into the top of its cycle, we move on. That's why we haven't been buying in Sydney for a while. We'll come back into the Sydney market when we think it slows down, and we're very selective in terms of what we're buying in here in Melbourne. And it's usually our relationships with the agents that are giving us the off-market opportunities, as opposed to going to auctions, because we know there's going to be 3 or 4 emotional bidders there, and we're going to pay 2018, 2019 prices.
Yep, agreed. So I think there's a thing in financial planning world that diversification. So we always say, well, you should sort of specialise rather than diversify. So another sort of platitude is time in the market rather than time in the market. We want to get them both right. We want time in the market, so we want this to be a long-term game.
Yep.
But if we can be borderless and move our money into the markets that have the best outlook for the next 36 months, we can then just naturally leverage that to move into the next market that has the best outlook. So really good question there, Leighton. So our thoughts are timing the market can be done as well as time in the market as well.
Brilliant. Now, I wanted to talk about Glenn Stevens' RBA announcement, but we haven't got time.
No.
So we'll bring it. No. We'll go next week.
We'll go next week.
Yeah, we'll
go next week. Roll it over.
Well, there's a lot to talk about, so I want to unpack it properly. So we don't have time. But I'll just pick, big statement. So I want to address it. I think it's important.
No tease for next week.
Oh well, just he was basically challenging the whole concept of borrowing money to leverage into residential property. He found it to be not a sensible move in the current environment. So it's a really topical point. So we need to get into it and unpack it more. And obviously that'll lead into the conversation around apartments and oversupply. I think winter is coming.
Winter is coming. There you go, folks.
If you listen to if you watch Game of Thrones, winter is coming. So I'll unpack that more in the next week or so.
Do you know how you just said I'll unpack that more? Do you know that on our reviews, we've got 100 plus reviews, so thank you for those people. And the amount of people that tongue in cheek say how much we unpack on our podcast. So I've just realised for the first time we actually do say it a lot. So,
all right, so negative gearing.
Yeah, that's
all right.
Next
what
week.
I want to talk about for negative gearing quickly. I wanted to make a key point. The key point I want to make is in regards to some of the research talking about the correction in property values. We've heard people like Aussie John saying 10 to 20%. We've heard people like Roger Montgomery saying more like 30%. Like these are big numbers. The Macquarie Bank guy saying 30%. We're seeing the Grattan Institute say it's probably more like maybe 3 to 5%. So if I just work on 5%, because that's the lowest number of what it's going to be more than that. Trust me, it is. If negative gearing does get up. So could you imagine, someone who had a $500,000 property, there's, $15,000 just wiped off the value of their home in terms of
straight up.
No, it's more, isn't it? 5%? No.
How much? How many percent?
5%? It's 25.
Yeah.
25 grand.
Yeah.
So 25 grand wiped off the property value.
Yep.
Then you've got someone who's got $1 million property, there's $50,000 wiped off your value. So it's going to affect every household because it's not going to discriminate. It's not just going to be on the people who own an investment property. It's, that's revaluing the marketplace. So there's potentially hundreds of millions of dollars, hundreds of millions, if not billions of dollars at risk. You talk about a property market, $6.3 trillion. There's potentially $1 billion that's going to be wiped off the value of households' wealth. I just don't get it. Doesn't make sense. It's basically bringing a sledgehammer to a problem that needs to be solved through supply and affordability. It's not something that we think is sensible.
Here. Very well said, Kingsley. Very well said. All right. So, Ivers has just made a suggestion. Can you sign off in Game of Thrones?
I don't think there is a sign off in Game of Thrones. So, nice try, but play the music. I don't know. I can't do that. Bosnian.
Oh,
we're going Bosnian.
Oh, you did Croatian last week for Damien. Was it that last week? Croatian? He said
it was.
He said you did all right.
He said the first one was good.
As much as it pained me to say this and give you this feedback, he said you did all right in the first one. But then you did the French accent talking to the young children. So we'll see how we go.
All right. So apparently I do it all right the first time, and then when I try and really pronunciate it, it gets destroyed. Here we go. Bosnian. Zdravo.
Yeah, see,
the
further it goes.
No, I'm Russian. Zdravo. Bravo. I don't know whether the Z at the front is silent or Zdravo.
No one gets to this stage of the podcast anyway, so it's just you and me humouring ourselves. No one really gets to the end, let's be honest. But if you are here at the end, folks, we will see you next week with Ben giving you a bit more about what Glenn Stevens said about property investing. So until next week.
Winter is coming.
Until next week, whatever Ben said in Bosnian.
Zdravo.
All right, folks, have a good week. See you next week.